We have somebody who became pretty well known in this town as a co-founder of Benchmark Capital. He's also co-founded Wealthfront, and he coined the term product market fit. And he's going to go talk about that today as applied to the wealth management space. And to talk with him today, to interview him, is Mike Volpi from Index Ventures. Please join me in welcoming Andy Rachleff and Mike Volpi. Thank you.
Good afternoon, everybody. I'm Mike. This is Andy, in case you were confused. It's a pleasure to be here. I can't say enough great things about Andy. Probably the most wonderful one is that Andy and I have been friends for getting close to 20 years now. Back when Andy was at Benchmark funding a number of formidable competitors that we had to fight off when I used to work at Cisco. And so I'm glad he's not doing that for us anymore. He was a fantastic venture capitalist, obviously, and now he's an amazing entrepreneur. One thing to note is that Andy got a very important announcement today. He was awarded the prestigious Outstanding Financial Executive Award from FMA, the Financial Management Association, which is a huge win for him and for Wealthfront. Past winners of this award include Janet Yellen. Some of you may have heard of her. Jack Bogle, David Booth, the Chicago Business School is named after David Booth, and Cliff Asness, who is the founder of AQR. So, Andy, congratulations on that prestigious award.
Thank you.
So just to kind of get the ball rolling, Andy, I want to ask you one question. You often talk that fintech is primarily about big fin and little tech. What do you mean by that? What are you trying to say with that statement?
Well, most companies in fintech seem to be marketing companies. They put a thin layer of user interface on top of an ancient infrastructure. And that's actually how we got started as well. In the very beginning, in December of 2011, we basically built a graphical user interface on top of open source asset allocation software and an ancient brokerage infrastructure. And our PR consultant at the time wanted to brand our technology the Precision Investment Platform, and our CTO, Mike is on our board of directors, so he knows our CTO, said, I will leave the company if you brand our technology, because there's nothing there. And over time, we have really focused on continuing to add more and more capability through technology. And what I've noticed is very few companies in fintech actually care about the technology. And if you want to build a big, sustainable, great enterprise in technology, you have to be a great technology company. So it disappoints me how few fintech companies care about tech.
So just as a backdrop here, how many employees at Wealthfront now?
160.
And how many of those are software developer and engineers?
90.
So that's a significant portion of your team, obviously.
And we hope it always will be.
Yeah, and in terms of how do you see that mix shaping going forward into the future between software developers versus the rest of the company?
Well, I would hope that it will stay at that ratio, that if we want to compete on product versus marketing, then we have to keep that kind of ratio.
Okay. Obviously, one of the things in the investment advisory business that you hear a lot about is the desire for people to talk to human beings, talk to advisors, talk to somebody that can calm them when things are going poorly, that can think about their future, that knows their family, and so on and so forth. Famously, Wealthfront has added no advisors. Talk about that a little bit. Why are you doing that? Why don't you want to add some advisors? If people want to talk to you, why don't they let them talk to you?
Okay, well, it's a function of who we focus on, where we found our product market fit. So our service is built for young people who want to delegate the management of their finances, who have less than $1 million to invest. Now, typically, high quality financial advisors require a minimum of at least $1 million. So if you want to delegate your finances and you don't have $1 million, then you're out of luck. So we built something that's ideal for young people because they don't want to talk to someone. As a matter of fact, our clients tell us, we pay you not to talk to us, which is a really, really strange thing. Now, I'm 59 years old, so I'm a baby boomer. And people my age want to talk to someone. And that's great, but millennials absolutely don't. When
The Rotary Club is great for that.
Exactly. So like if I want to call my kids, I have to text them to call me because they've turned their ringers off. They don't talk.
Yeah.
So we're trying to build the ideal service for an audience that's very, very different. We think it's the growth audience for the industry, and whereas the traditional industry believes that when they turn 50, they're going to want to talk to someone. To me, that's like saying if you listen to rap as a kid, when you turn 50, you're going to listen to symphony. Just doesn't make any sense.
Yeah. And would you change your mind if people showed up with more money? Let's say instead of $1 million, they want to give you $20 million to manage if they have somebody to talk to?
You know, we have one client who is a non-affiliated client, so someone who isn't an investor, an employee, who's given us $35 million. But we usually try to talk them out of it because they're going to be disappointed. They're going to want to talk to someone. And if they're disappointed, they're going to tell others that they're disappointed. We'd much rather focus on the people for whom we have the ideal solution. Mm-hmm. That's the core essence of product market fit. That taking people outside of where you have the greatest fit feels like it's helpful, but it actually can detract from your business.
And do you think that core customer set, the one that doesn't want to be talked to, is a large enough market for Wealthfront?
Oh God, yes. Well, millennials are a larger generation than baby boomers. So they're the largest generation in the history of this country. I think there's something like 92 million of them. And they're in the wealth accumulation phase of their lives, not the wealth preservation phase, as are the baby boomers. So over time, their wealth is going to grow. I think that baby boomers have 16 trillion managed on their behalf. There's no reason why millennials aren't likely to have that amount managed as well. You know, another misperception is that we want to take people away from financial advisors. Nothing could be further from the truth. That we're trying to serve people they don't want.
Yeah. Another sort of characteristic of Wealthfront where you're bucking the trend is that you don't advertise. You don't advertise on TV. You do hardly any paid acquisition of users. Why not?
Well, because I'm such an advocate for product market fit, I think that it can actually distract you. And by that I mean that the way that you know you have product market fit is if you have exponential organic growth. That's not an easy thing to do. And advertising can actually make you think you're doing well because you're buying customers when in fact you're not. So the only way you drive exponential organic growth is through word of mouth. So when I came back as CEO, I got rid of almost all the advertising because I wanted to, there's a Japanese saying in manufacturing that you can't see the rocks until you drain all the water. Mm-hmm. So by getting rid of the advertising, we could actually see if we were driving exponential organic growth. So that's number one. And number two, the economics for advertising are just awful in our world. We charge a quarter of the fee of the incumbent. So we charge 0.25% to advise our clients, whereas the industry charges 1%. If they have the same internet channels available to them, advertising channels, then how can we ever have an economic ad? Because they can afford to spend 4 times as much. We can only advertise in places where the incumbents can't. And that's a very limited limited opportunity.
Mm-hmm. Which obviously leads me to the corollary question about making money. You do charge a quarter of what the average market does. How do you ever make money as a business with
volume.
such low fees? You lose $1 and make it up in volume?
Volume, right. Now, fortunately, the market is so big that this is a classic venture capital bet. You're investing in a fixed cost, hoping that the market is big enough to support that fixed cost. I did that all the time. You did that. You do it all the time as a venture capitalist. It's very unusual to an existing financial advisor. They're not used to the venture capital model applied to their world because they all had a bootstrap. Mm-hmm. But if you can invest in the infrastructure and the technology and build products that hopefully you can attract a very large audience. And we went from 0 to 1 billion under management in a little under 3 years. We went from 1 to 10 in a little over 3 years. And history tells us that people who grow big companies take the same amount of time to go from 0 to 1, 1 to 10, 10 to 100. So that means we're now at almost 11, so we should get to 100 in less than 4 years. And at that point, because it's all engineers, it's really the potential to be a really high margin business.
Yeah, and is your view that audience your users will continue to discover you in that organic manner over time? That advertising is not just sort of a stage thing of where you're at, and then when you grow into a larger size company, you'll start advertising. But do you believe that sort of organic word of mouth is something that will continue to help your surge in client base and in AUM?
Well, when was the last time you saw an ad for Netflix or Facebook or Google or Spotify? I mean, the great products, the great companies were all built through word of mouth and through great product. So that's why we try to reinforce the business model we've chosen to have a lot of engineers and product-focused people, because if we can delight our clients, delight is the greatest form of virality.
So we kind of hit a few points here where you're obviously taking a very unconventional approach to this business of asset management. Do you generally think that for a young business to be successful, you have to be non-consensus?
I do. My investment idol is a guy named Howard Marks, who founded a firm called Oaktree Capital, which is probably the best distressed debt investor in the world. And Howard is as well known for his quarterly letter to his clients as he is for his great returns. And every one of these letters is premised on the same framework, which is investing can be described with a 2x2 matrix. On one dimension, you can be right or wrong. On the other dimension, you can be consensus or non-consensus. Now, obviously, when you're wrong, you don't make money. But what most people don't realize is if you're right in consensus, you don't make money because the returns all get arbitraged away. The only way you make big returns as an investor or an entrepreneur is by being right in non-consensus. So trying to do a better job of what somebody else does, that's a path to mediocrity.
Mm-hmm. Mm-hmm. Yep. And certainly historically.
By the way, I might fail, but I'd rather fail trying than try to copy others.
Given that we put a fair bit of money into this investment, I hope you don't. But one of the things that Andy's known for, I didn't mention it in the introduction, but he's a lecturer at the Stanford Business School. And he's not just a lecturer, but if you actually go in and ask the students, or if you look at just how much students have to bid to get into Andy's class, he's one of the most popular teachers at the business school. He is as much as anybody else responsible for this terminology that was brought up earlier called product market fit. And you used it a couple times already in describing what you do. Talk about that in a little more depth. What do you mean by product market fit? And importantly, when do you know you have it?
Sure. Well, I think the original idea came from Don Valentine from Sequoia Capital. He just didn't come up with a term for it. So I observed how well Sequoia did over the years, and I wanted to learn from that. I would say that the best way to describe what product market fit is to use terminology that Eric Ries used in the Lean Startup. He says that you need to, when you're starting a company, you need to first develop a value hypothesis, which needs to be confirmed, and then a growth hypothesis, which needs to be confirmed. The value hypothesis consists of the what, the who, and the how. What are you going to build? For whom is it relevant? And what's the business model? That's the how. Now, most people don't realize that you don't iterate on the what. So great technology companies are created by virtue of an entrepreneur recognizing an inflection point in technology that allows them to build a new product. For us, it was brokerage APIs and ETFs. And then you have to figure out who cares? What's the market? What's the who that matters? And maybe what's the business model that'll work? So proving the value hypothesis, to me, is the core of the product market fit, finding the market that cares for your product. You don't start with a market, look for problems to which you can find a solution, because that's right in consensus. And that leads to very mundane outcomes and certainly doesn't support venture capital. So the great returns in venture capital have all come from people who have tried to do something that's non-consensus.
And why do you describe that advertising cloud's product market fit?
Because the way that you really know that you found it is if you have exponential organic growth, if you have word of mouth. People only recommend things that they love.
Yeah.
And that's how you know you found it. And believe, I've seen many entrepreneurs get fall in love with the growth that they've gotten from their advertising and not realized that they're not getting word of mouth.
Would you say that you have it now, product market fit?
Absolutely.
Good.
The neat thing is we found our second one, which was planning. So we started with investing, and then last year, about a year ago, we delivered automated financial planning, and that actually accelerated our growth rate. It's very unusual for a company that's 6 years old or then 5 years old to see an acceleration in your growth rate. That's another way that you know you found it.
Yeah, now you've brought up an interesting point, which is that the product portfolio that Wealthfront has now has enhanced significantly since the very early days where you were just doing straightforward asset allocation. Now, some people have positioned that, some of your competitors, so as you're pivoting, you're switching from one business to the next. Would you characterize what you're doing as pivoting? Or how would you characterize the fact that you're adding product lines to what Wealthfront offers?
So the word pivot, I think, really entered the vernacular with Eric Ries in the Lean Startup, and he uses it to mean iterating on the market, iterating on the who, not the what.
Yep.
So adding more features that someone can use, to me, is not pivoting, and I'm always surprised when people refer to it that way.
Yeah, and I imagine that with 90 engineers on your team now and growing, there's a rich future roadmap of additional capabilities that you're going to add to the product so that you can serve people better.
And not all of them are going to succeed. So I don't think about the percentage of those products that succeed. I think about the magnitudes of the ones that do. In venture capital, the key to success is not the percentage that work out, but how well the ones that do work out.
Which brings me to an interesting point. So you've had a very unusual career. A bunch of us, myself included, have been entrepreneurs, and then we've switched to a career in VC.
The normal way to go.
Yeah, you went the other way, unconventional as always. How has that helped you in being a better entrepreneur?
You know, I don't think it has made me a better executive. As a matter of fact, I used to teach a class with Mark Leslie, who founded a really successful company called Veritas Software. He grew it into a $1 billion business. And Mark was not very fond of venture capitalists, so we taught together for 9 years. It took a little while for him to accept me as his teaching partner as a former venture capitalist. And when I started Wealthfront, he was so happy because I was now finally an operating guy. And he said, God, you would be so much better as a venture capitalist now with this experience. And I said, actually not, because the things that made me good at venture capital, recognizing a good idea, very different than driving an idea to success. So I think it's made me a better director in that I talk less because I appreciate how difficult it is to make
I don't get
the
to talk
sausage.
much in board meetings with you.
But I think the one thing that it has helped me with is an appreciation that not every product idea will or should work, and don't worry about that. Just really lean into the ones that do.
And when you were a venture capitalist, what percentage of the ideas that you invested worked and created positive returns? Was it more than half, less than half?
Well, I think something like 70% created positive returns, but positive returns are worthless. The only ones that mattered were ones that were 10x or more.
Yeah, and do you think of product development in the same context?
I do, actually, and that's not typical.
Yeah. Good. I know we're sort of short on time here, so I've got one more question for you. You do something that's a little bit unusual for entrepreneurs in younger companies today, is which you talk about going public of an IPO. These days, entrepreneurs are figuring out lots of interesting ways of postponing that. Why is it important to you to go public, especially for a relatively young company? And how are you thinking about that eventual milestone in your business?
Well, look, if you're Facebook or Uber and you're well known throughout the world, there's no need to go public. But going public adds tremendous credibility. And over the years, what we've learned is it's the best free marketing that a new service could get. So especially in a trust business, and I think all of us who are in fintech are in trust businesses, it can make a tremendous difference to your rate of growth, first and foremost. Secondly, the thing that most people don't appreciate is that when you look at the way companies grow over time, the most common way for them to reinvent themselves is through acquisition. Apple and Netflix and Amazon are really unusual in that they did internal development, but almost every other company that you know of that has continued to succeed over long periods of time have done so through acquisition. And unless you have a public currency, you can't do that.
And when you go in public, the proceeds that you get from that public offering, do you need to run your business with that?
No, I actually think you should run your company like a private company. You don't have to run it for the investor who invested just yesterday. You're worried about the long term. So you don't need to run it quarter by quarter. And there are a lot of great examples now of people who ignore quarterly earnings and they've built amazing enterprises. The greatest example is Bezos and Amazon.
Fantastic. Good, Andy. I think we've run out of time. Please join me in giving him a big round of applause, Andy Rachleff.